Imagine you just bought a data center. You think you understand the business. Companies rent space. Companies pay rent. You collect the difference. It isn't that simple, because on your very first day, before a single server is even plugged in, you have already spent more money than most companies spend in a decade. The building alone can cost more than a professional football stadium, the permits can take longer to secure than the power grid connection itself, and the computers you're counting on to make you rich are actually one of the smaller line items on the budget. Here's the strange part. The most profitable data centers in the world are not the ones with the most servers. They are not even the ones with the fastest computer chips. They are the ones that figured out something else entirely. Something that has almost nothing to do with processors, memory, or bandwidth. A data center is not really a computing business. And once you understand what it actually is, you will never look at the internet, your bank account, or the AI chatbot on your phone the same way again. Here is the sentence that changes everything. A data center is not a computing business. A data center is a real estate and utility business that happens to have computers inside it. Sit with that for a second. The servers on the racks, the cooling systems, the processors training the next AI model, they matter. But they are not the whole story. The real business is built around securing land, securing electricity, and guaranteeing that whatever is plugged into that building never, ever stops running. Computing is simply the most profitable activity you can put inside that guarantee. Think of a data center less like a computer warehouse and more like an insurance company. An insurance company doesn't make its money by predicting disaster perfectly. It makes money by pricing risk and collecting premiums whether disaster strikes or not. A data center works almost exactly the same way. The servers are the policy. Uptime is the premium. So what does it actually cost to open a data center? Start with land. Data centers need substantial footprints, often 10 to 50 acres, in locations with strict power availability and zoning approval. In major markets, land alone can run into the tens of millions of dollars before a single wall goes up. Then comes construction. A large data center campus isn't a simple building. It's an electrical substation, an industrial cooling plant, and a fortress combined under one roof. Costs regularly climb past $1 billion. And for the newest AI-focused campuses, well past $10 billion. Then permits and power. Grid connection approval alone can take years to secure, costing millions in studies and upgrades, with no guarantee of a fast timeline. Then equipment. A single server rack loaded with specialized AI processors can cost between $200,000 and $300,000. A large facility might need thousands of them. And then the number almost nobody accounts for. Working capital. Enough cash reserves to operate for months while the facility fills with paying tenants, because even the best located data center does not turn a profit in its first year, sometimes not even its first several years. Here's the trap that has swallowed dozens of data center developers. They budget for the building, they forget to budget for the years it takes the building to fill up. Not every data center is playing the same game. At the bottom of the market sit small enterprise data centers, private facilities a single company builds to run its own internal systems. Their economics depend on control, not scale. In the middle sit retail co-location facilities, places where dozens or hundreds of companies rent individual racks and cabinets inside a shared, professionally managed building. These blend security, connectivity, and reliability for a broad range of customers. At the top sit hyperscale and wholesale data centers, the campuses built for cloud giants and AI companies. These properties often make more money from a handful of enormous tenants than from thousands of small ones combined. Then there is a separate category entirely. Edge data centers, small facilities placed close to where people actually live, built to shave milliseconds off delivery speed for things like video streaming and online gaming. And finally, the newest category, purpose-built AI training campuses, which carry power and cooling demands unlike anything the industry has built before, and are quietly reshaping the entire industry's economics. Now, here is the first assumption most people get wrong. People think data centers make their money from thousands of small businesses, each renting a modest rack of servers. They don't. Not primarily. The truth is that a small number of tenants generate a disproportionate share of data center revenue. Industry data has long shown that a handful of hyperscale cloud and AI companies, often called anchor tenants, can account for a large portion of total leased capacity at major campuses. This is why data center operators build entire teams around identifying, courting, and locking in these tenants years before a building is even finished. Pre-leasing agreements, multi-decade contracts, dedicated account teams available at any hour. The small business renting 2 racks is not the business. They are the background noise. The real business is built around identifying the handful of tenants who will sign a contract for 50 megawatts and stay for 20 years. Here's what nobody tells you. A data center operator would rather lose 1,000 small tenants than lose one hyperscale anchor client. Let's break down where the money actually comes from, stream by stream. Stream 1. Co-location. A customer rents physical rack space, brings their own servers, and pays every month for the power, cooling, and security keeping those servers alive. Co-location requires no construction and no waiting years for a grid connection, and the margin is built directly into the rent. It scales beautifully, since a facility can add tenants with almost no additional labor cost per rack. Stream 2. Wholesale and hyperscale leasing. Instead of renting a rack or two, a huge customer like a cloud provider leases an entire section of the building, sometimes an entire building, locked into a contract that can run for a decade or longer. These carry a smaller margin per square foot than co-location, but they generate massive, predictable volume and the long-term stability lenders love to finance. Stream 3. Cloud infrastructure itself. Companies like Amazon and Microsoft don't just rent hardware to others. They sell raw computing power by the hour, letting businesses run entire applications without ever owning a single server. Stream 4. Cross-connect fees. Once hundreds of companies sit inside the same building, they often need to exchange data directly with each other. The operator charges a fee just to run a short physical cable between two customers' equipment. It costs almost nothing to provide, and companies pay for it every single month, because it shaves crucial milliseconds off their connection speed. Milliseconds that matter enormously to a bank or a trading firm. Stream 5. Power and managed services. Electricity billed on top of rent, often with a markup, plus fees for the data center's own engineers to handle maintenance, so the tenant never has to hire their own team. Stream 6. Disaster recovery. Businesses pay to keep a mirrored backup of their systems in a second location, ready to take over instantly if the primary site ever fails. There is a seventh stream now reshaping the entire industry. High-performance AI computing, where customers rent rooms full of specialized processors built to train artificial intelligence models, often at far higher margins than traditional co-location, because demand for that capacity currently outpaces supply almost everywhere on Earth. 7 streams, one purpose. Guarantee the tenant never loses power, never loses connectivity, and never has a reason to leave the building. Now let's flip it around, because the costs nobody imagines are often what separate a thriving data center from a bankrupt one. Start with electricity. A data center campus runs 24 hours a day, 7 days a week. Servers, cooling systems, and backup infrastructure across hundreds of thousands of square feet never stop. And utility bills at large facilities can run into hundreds of millions of dollars a year. Then maintenance. Cooling systems, backup generators, batteries, fiber connections, fire suppression. A data center that suffers even a brief outage loses customers to the competitor down the road, so constant investment isn't optional, it's survival. Then regulatory compliance. Facilities handling financial or healthcare information operate under some of the strictest oversight of any industry, and every system inside the building can be audited, certified, and reported on. Compliance teams and constant inspections cost money every single day, whether the building is full or half empty. Then taxes and permits. Property tax rates vary enormously by jurisdiction, and many regions now attach ongoing fees tied directly to power consumption. Then insurance and security. Buildings holding sensitive data around the clock require surveillance covering nearly every square foot, layered access control, and premiums that reflect the property's enormous liability if something goes wrong. Then financing. Almost no data center is built entirely with cash. Most are financed with enormous amounts of debt, and that debt comes with interest payments that must be made whether the building is fully leased or sitting half empty. And finally, staffing. Engineers and technicians who understand mission-critical infrastructure are in short supply, and the cost of constantly recruiting and training new staff quietly eats into margins that look enormous on paper but shrink fast in reality. This is the part amateurs never see coming. The building can be fully leased every single month, and the company can still lose money because of what is happening behind the scenes. Here is the biggest surprise in the entire industry. The largest data center is not always the most profitable data center. A massive campus, packed with thousands of small co-location tenants, can look impressive, but it can actually generate less profit than a smaller facility built around a handful of hyperscale clients who sign decades-long, high-value contracts. Think about it this way. Square footage creates the illusion of success, but contracted power and tenant commitment are what actually build wealth. This is why data center executives obsess over a metric most people have never heard of: megawatts under contract, not square feet leased. It measures exactly how much guaranteed, paying power capacity a facility has locked in, regardless of how the building looks from the outside. A data center operator does not care how many blinking lights are on the floor. It cares about contracted megawatts. The small colocation tenant and the 50-megawatt hyperscale anchor might look like they belong to the same business. They don't. One is the background hum, the other is the entire foundation. None of this works without understanding how businesses actually make decisions. Data centers are, at their core, built around how corporate decision-makers respond to risk and reward. Take loss aversion. Losing a company's data, or losing even a few minutes of uptime, hurts a career far more than saving a little money on server costs helps it. So data center contracts are built around guarantees and penalty clauses, letting a nervous decision-maker feel protected before anything even goes wrong. Take herd behavior. Choosing the same major cloud providers and data center operators that everyone else already trusts feels safer than choosing an unfamiliar, cheaper alternative, even if the alternative is technically just as capable. Take switching costs. Once a company's systems are deeply integrated into a provider's infrastructure, moving to a competitor feels expensive and risky, keeping tenants locked in far longer than any contract requires. Take status and trust. Being hosted inside a top-tier, highly certified facility signals legitimacy to a company's own customers and investors, the same way a prestigious address signals legitimacy for any business. And take the illusion of control. Every dashboard, every uptime report, and every service agreement exists to make a customer feel like they're managing risk, even when the truth is they've simply outsourced it. Now, here's why the building itself looks the way it does. Data center campuses are famously layered, and that is deliberate. Perimeter fencing, then a guarded gate, then biometric access, then individual locked cages around each customer's equipment, are designed to reassure a tenant just enough that they feel completely secure, without ever slowing down their own daily operations. Cooling infrastructure sits at the core of the building, not off to the side, because every other design decision, from ceiling height to airflow direction, exists to move heat away from racks that would otherwise overheat within minutes. Backup generators and fuel tanks sit far from the main structure, but close enough to switch on in seconds, protecting the building from fire risk without costing precious response time. Locations are chosen with equal precision. Regions with abundant electricity, favorable climates, and dense fiber routes are prioritized because power availability directly drives how much revenue-generating capacity a facility can ever hold. And behind all of it, sophisticated software tracks power draw, temperature, and equipment performance minute by minute, adjusting cooling and load distribution based on exactly how much revenue each rack is generating. Every wall, every corridor, and every generator in a data center exists because someone calculated that it would make more money that way. Beneath the server racks sits a legal and financial machine most tenants never think about. Every large data center operates under long-term power purchase agreements with utilities or energy producers, and those agreements can be renegotiated or strained during periods of extreme regional demand. Losing favorable power pricing does not just cost money, it can undermine the entire economics of a facility overnight. Then, there are the contracts. Service-level agreements guaranteeing specific uptime percentages, co-location leases spanning years or decades, and interconnection agreements between tenants who need to exchange data directly, each with its own pricing and penalty structure. Then, there is debt. Data center operators are typically financed through a mix of bank loans, corporate bonds, and increasingly, real estate investment trust structures, often carrying billions of dollars in long-term debt. That debt load is treated as normal in the industry, but it also means that during any period of rising interest rates, an operator can be generating healthy revenue from its tenants while still struggling to make its interest payments. Then there is liability, from data breaches to service outages, all requiring insurance reserves for claims that may never happen but must always be covered for. And running through everything is compliance, financial regulation, healthcare privacy law, and international data protection rules, all requiring constant certification and reporting to auditors, who can review the books and the building at any time. This is the invisible architecture. The servers and the cables are just the surface. Let's look at what happens when this entire system breaks down, using one of the most dramatic collapses in modern data center history. In 2017, a group of investors bought the data center division of a major telecommunications company for roughly $2.15 billion and built it into an independent company called Cyxtera Technologies. Its founders made a deliberate bet. Rather than owning the land and buildings outright like most of its major competitors, Cyxtera would lease many of its facilities from other data center owners, keeping upfront costs lower and allowing faster expansion across more cities. For a moment, it looked like a triumph. Cyxtera grew into the third-largest retail colocation provider in the United States, operating around 60 facilities across 23 metropolitan areas, serving more than 2,300 customers worldwide. In 2021, it went public, riding the same wave of cloud adoption, lifting the rest of the industry. But underneath the growth sat a hidden problem. Nearly all of Cyxtera's debt carried a floating interest rate, and a large share of its buildings were leased rather than owned. When central banks raised interest rates sharply, Cyxtera's annual interest payments more than doubled in about a year, climbing from roughly $36 million to over $75 million. At the same time, the company had never turned a profit, reporting a net loss of over $350 million in a single year, with an accumulated deficit surpassing $1.5 billion. Cyxtera's stock, which had traded above $14 a share, collapsed to just a few cents. In June of 2023, with debt maturities closing in and no buyer or refinancing deal in place, Cyxtera filed for bankruptcy protection. Thousands of customers were left waiting to see whether their leased facilities would even stay open. What happened next revealed just how far the value had fallen. After months of court proceedings, Cyxtera's data centers were sold to a major investment firm for $775 million, a small fraction of the roughly $2.15 billion it had cost to assemble the company less than a decade earlier. The lesson is not that colocation businesses fail. Demand for data centers was, and still is, exploding. The lesson is that a company's financing structure has to survive the same volatility as the market it operates in, not just the good years. Cyxtera bet that leased buildings and floating rate debt would let it grow faster than its competitors. When interest rates moved against it, that same structure is what took the company down. Cyxtera's collapse was not an isolated failure. It was a symptom of an industry going through a much larger shift. For decades, data centers competed primarily on square footage, location, and price per rack. That competition still exists, but it's no longer the main event. Artificial intelligence has flipped the industry's central currency from floor space to electricity. At the same time, the customer base has consolidated dramatically. A handful of cloud and AI giants now account for a huge and growing share of new data center demand, giving those companies enormous negotiating leverage over operators competing for their business. Interest rates and construction costs have also reshaped the map. Projects that once looked easily financeable now require far more certainty around long-term, contracted revenue before lenders will fund them, exactly the certainty Cyxtera's leased, floating-rate structure never had. Government policy keeps moving too. Some regions are racing to attract data center investment with tax incentives and streamlined permitting. Others are pushing back, worried about strained power grids and rising electricity prices for ordinary households living near these facilities. And increasingly, the biggest cloud and AI companies are choosing to build and finance their own power generation directly, rather than waiting for the grid to catch up, a move that would have sounded absurd for a technology company just 10 years ago. The old formula, build a big building and let tenants walk in, no longer guarantees success on its own. So how have the companies that survived actually adapted? The biggest shift has been power procurement. Major operators now sign long-term deals directly with power producers, including nuclear and renewable energy projects, locking in supply years before a building is even finished, rather than hoping the grid has capacity when they need it. The second shift has been cooling technology. Liquid cooling is replacing traditional air conditioning inside the newest facilities, because AI chips now run too hot for air alone to handle efficiently, and operators who adapted early are winning the highest value AI tenants. The third shift has been ownership structure. Rather than leasing buildings the way Cyxtera did, many operators now favor owning real estate outright or forming joint ventures with deep-pocketed partners, spreading risk while keeping enough control to survive a downturn. And the fourth shift has been consolidation. Smaller, undercapitalized operators have increasingly been acquired by large companies and investment firms with the balance sheets to survive the exact kind of interest rate shock that ended Cyxtera. The data center companies thriving today are not necessarily the ones with the most buildings. They are the ones that stopped thinking of electricity as an expense and started treating it as the product. So what does success actually look like? If everything goes right, a data center campus opens in a location with abundant, reliably priced power, backed by a level of debt the property can comfortably service even if interest rates rise. Its revenue streams work together instead of competing, with a mix of retail co-location and long-term hyperscale contracts balancing steady income against enormous, stable volume. Its leasing team locks in anchor tenants years before the building even opens, and those relationships keep the campus close to full for decades, not months. Costs stay predictable, and the company continually reinvests in cooling and power infrastructure rather than falling behind newer competitors. Under this scenario, a data center becomes something close to a toll road for the digital economy, throwing off reliable profit for decades, largely insulated from the ups and downs of any single customer or any single industry trend. Now flip it. If one thing goes wrong, the damage rarely stays contained to that one thing. Say interest rates rise sharply while a large share of a company's debt carries a floating rate. Interest payments climb just enough that the company can no longer comfortably cover them from operating income, the same income that looked more than sufficient just a year earlier. To cover the shortfall, management delays maintenance. Cooling systems age, reliability slips, and a facility with a reputation for instability loses the next AI tenants to a better-financed competitor. At the same time, the company's largest tenants, the handful of hyperscale clients responsible for an outsized share of revenue, are watching closely. A single missed uptime guarantee can send an anchor tenant elsewhere, taking a massive chunk of annual revenue with them. Lenders, sensing risk, tighten terms or refuse to refinance. Landlords, in facilities the company doesn't even own, grow uneasy about a struggling tenant. Within a few years, a data center company that looked unshakable during a boom can find itself exactly where Cyxtera did, filing for bankruptcy, not because demand for computing power stopped growing, but because its financing couldn't survive the years it took to cash in on that demand. Before we close, here's where this is heading. Over the next 10 years, expect electricity, not land or construction, to become the deciding factor in where new data centers get built, as artificial intelligence pushes power demand to levels the current grid was never designed to handle. Nuclear energy, including a new generation of smaller, faster-to-build reactors, will move from announcements to actual signed contracts, though more slowly than the biggest tech companies are promising. Ownership structures will keep shifting too, as lenders grow cautious about financing buildings operators don't own, favoring companies with balance sheets to weather the next rate shock. The data center companies best positioned to win are not the ones building the tallest towers. They are the ones already treating themselves as power companies with a computing business attached, not computing companies that happen to need electricity. The building will always matter, but increasingly, the power contract behind it might matter more. So here is the truth, reduced to its simplest form. The server room is not the business. It is the bait. The real business is a company that secured enough land, enough electricity, and enough certainty to guarantee that whatever a tenant plugs in will keep running, no matter what happens outside the walls. The processors and cooling systems matter, but they are simply the most efficient tool the digital economy has ever found for one purpose: keeping the modern world online. Take away the computing, and you still have a real estate company, a utility, and an insurance policy rolled into one. Take away the guarantee of uptime, and the computing alone has never been enough to build an empire. A data center doesn't just win because it owns powerful machines. It wins because it built an entire system designed to make you never have to think about whether it's still running. Every industry hides an economic system most people never see. Casinos aren't just games of chance. Airports aren't just travel hubs. Data centers aren't just warehouses of computers. If you want to understand how the businesses around you really make their money, subscribe, because we're going inside a new industry next.